Hello, everyone. A very warm welcome. We would just wait for a few more minutes until more people join us for this webinar. Hello, everyone. I'm Sharyu Bafna, and I would like to welcome you all to today's webinar hosted by Cashflow. Now, with the integration of Logitax, Cashflow now provides enhanced offerings in AP automation, payments, reconciliation, GST filings, supply chain financing, ERP integrations, e-invoicing, and GST ITC maximization. Now, I would like to welcome our today's speaker, Mr. Hanish S. Hanish is a CA by profession and is a partner at CNK HSKA, Bangalore. He has more than 15 years of proven work experience in the field of indirect taxes and GST. He works closely with clients engaged in complex businesses like pharma and real estate. Hanish heads the litigation practice and has represented clients at various judicial forums. I would now ask Hanish to introduce himself again and begin with the session.
Good evening, everyone. I am very happy the way Logitax is growing. Earlier, it was providing certain solutions restricted to only GST, and now they have entered into other value chain services as well. So congratulations to the entire team of Logitax. Now, today we are here to discuss on the amendments in the GST law pursuant to the GST Council meeting, the 53rd GST Council meeting, which concluded. And every day we see that whenever we get up in the morning, by night 12 o'clock, 1 o'clock, 2 o'clock, there'll be some notifications which have been issued, or some amendments which have been issued, or certain circulars which have been issued. So today, what we'll try to do is attempt to try and cover as many amendments as we can in the 1 hour of allotted time, and then maybe 10 to 15 minutes for question answers. Right. So right straight, let's jump into the presentation. I'll share my screen. So let me know if there is any issue in the screen which I'm sharing. Yeah, is my screen visible? Okay. So we'll be discussing the circulars first. Only those circulars which are relevant, I have considered those. And like circular 208 relating to tobacco company, very specific to tobacco companies, not having impact on anybody else. So I'm not covering that circular. Okay. So first is a circular which provides the monetary limit within which the department can file the appeal. Now, this is not a very important circular for us, but just that we have to be mindful that if the value of tax is below a particular threshold, then unless the what you say issue comes under certain exceptions which have been provided by circular 207, the department should refrain themselves from filing the appeal, because department or government is known to be the biggest litigator, and this is through this circular is based on reduction in the litigation which the department is doing. So when you talk about, say, an order which is worth 20 lakhs of tax, and it's in the favor of the taxpayer, and if appeal is required to be filed by the department, then the circular says don't file. Or if the High Court, the matter is less than 1 crore of rupees, or Supreme Court, the value of the matter is less than 2 crore rupees, then they are not required to, they're not supposed to file the appeal unless they follow the certain exceptions, and those exceptions are also quite broad. So if they want to, they can definitely file the appeal. Okay. I'm skipping 208, now moving to 209. 209 is based on the background that section 10(1) CA was amended, of the IGST Act was amended to provide that the place of supply in case of sales made to unregistered persons will be the address mentioned on the invoice. That's what section 10(1) CA mentioned, said. But the issue was now in a B2C transaction where bill to say is Maharashtra, but ship to is, say, Karnataka. Example, you are in Maharashtra and you want to send some gift to your friend who is in Karnataka, then the invoice will have the address of both Maharashtra, which is bill to address, and Karnataka, which is delivery address. The issue now was whether the GST is required to be paid considering the place of supply as Maharashtra, which is bill to address, or Karnataka, which is the ship to address. In a B2B transaction, it is always the B2B address based on which the GST is charged. But the circular 209 clarifies that as far as B2C transactions are concerned, the place of supply will be determined based on the delivery state and not on the bill state. This circular says that it is applicable, it has been issued more specifically from the perspective of e-commerce operators. But because this circular is explaining the logic behind section 10(1) CA, it will apply to e-commerce operators as well as any other stores as well. Or for that matter, any other over-the-counter sales which are being made, and not just restricted to e-commerce operators. Next, when I import certain services from my related party, then what is the value on which I'm required to pay tax? That was one big issue, and lot of these services, were from the perspective of Schedule 1. So assuming I am a company which is in India, and my name is similar to what is my parent company's name, which is outside India. Okay, so take example of, say, Standard Chartered Bank. So outside India, my parent company also is called Standard Chartered. In India also, the company name is Standard Chartered. So what a lot of GST authorities were doing is they were saying that you are importing the services of name, of branding, or obtaining the name, okay, from your parent company, on which you are not paying tax. So when we would say that no, there is no consideration at all, or for that matter, whether it is a service at all or not, they would come back to us saying that, look, there is Schedule 1. Schedule 1 says transactions between related parties, even if there is no consideration, you are required to discharge GST. To provide some relief and to provide certain clarity from a department perspective, okay, what they have said is, if the recipient is entitled to claim the ITC, okay, then whatever value you declare, on the invoice at the time, because you are a recipient, you are required to pay GST. For you to claim the credit, you are required to raise a self invoice on yourself under section 31(3)(f). Whatever value you assign in the invoice, that will be the value on which you are required to discharge the GST. And if you have not raised the invoice, okay, then the value will be deemed to be zero. Now, earlier as well, there was a similar circular 199, which was issued, but that was issued in the context of uh, branch offices and head offices. So if head office is providing certain services to branch office, that circular would say that whatever value you have assigned on the invoice, that is the value on which you are required to pay GST. Okay, and if the invoice is not raised at all, then the value will be deemed to be nil. The entire circular 199, which was issued in the context of branch office and head office, has not, that logic has been extended even to related parties. Okay, so whether it is import or whether it is within India, the benefit has been extended. Benefit or the logic has been extended. Okay. Now the point here is this circular will be useful only if the credit is available in full. If the credit is not, so the valuation will not be questioned if the credit is available in full, and nil will also be accepted as a value. The issue now is, what if the credit is not available in full? Then what will be the value? In that case, any value will not be the value. I will have to find out the open market value or the value of the like, kind, and quality, or at least cost plus 10%. That is the value based on which GST is required to be discharged. Now, in an international transaction, how will we assign that value? How do we identify an open market value or a cost plus 10% value is quite a difficult question to answer. But the thing is, at least as far as cases where credit is available, we will not be dealing with any RCM notices as far as related party transactions are concerned. Okay. Now, where the credit is not available, like real estate sector or education sector, cases like bank, where they are entitled to only 50% credit, okay, and not full ITC, there we will have a lot of issues. Also, what if I have a business and I had some extra funds which I parked in a mutual fund and which I have sold. Now, mutual funds sale is treated as exempt supply for the purpose of computation of credit which is eligible to me. In this case, what will happen is the contention of the department would be that you are not entitled to full ITC, because this credit pertaining to related party is common for all the activities, including the mutual funds activity, and so the valuation could be questioned. So that is one issue which we may have to deal with as far as what is the meaning of full ITC is concerned. Okay. Now we move to another aspect of RCM itself, that is circular 211. Now what would happen is, again continuing with circular 210, whenever I receive any services on which I am required to pay tax under reverse charge mechanism and I avail these services from an unregistered person, I am required to raise an invoice on myself, and that invoice will be the basis for me to claim the credit. In GST, the credit can be claimed only based on an invoice, certain specific documents like invoice, input service distributor invoice, or it could be based on a bill of entry. Okay. So now in case of RCM, where the unregistered dealer has raised the invoice on me or given me a bill or a voucher, there'll be no mention of tax. Okay. So what I will have to do, I will have to raise an invoice on myself and claim the input tax credit on the same. The issue now was that if I have not paid the tax when I was required to pay the tax, I have received the services from a lawyer, I missed paying the tax. Okay. I paid it after the audit detected it. After 4 years, I paid it. Okay. Now the question was, when I have paid it after 4 years, can I claim the input tax credit of the same? The GST authorities would say, no, the transaction relates to 1718. You might have paid the tax now, but if you would have paid the tax in 1718, you would have to claim the credit within the due date of 1718, which was actually September 18, extended to March 19. That is the time limit within which you are supposed to claim the credit as far as 1718 is concerned, from 16.4 perspective, section 16.4 perspective. Because you have not claimed the credit within the due date for the relevant for 1718, this credit is now time barred. So the issue was, I will pay the tax now under RCM along with interest, along with penalty if there is any penalty. Okay, but I will not get the input credit of the same. Okay. Now circular 211 clarifies that you are entitled to claim credit based on invoice. Invoice has to be based on the due date of the credit has to be based on the date of invoice. So now if you are paying the tax after 4 years and you are dating the invoice after 4 years, so that means in our case, say 2021, okay, then the invoice pertains to 2021. The last date for claiming credit for the year 2021 was September 21. So as long as you have claimed the credit by September 21, it is all right. So even today, if you are paying any tax under RCM and you have, and the question is whether you are entitled to claim input credit or not, please raise the invoice today and claim the credit. Challenge will come when the notice, that is show cause notice, is issued under section 74. Because if the notice is issued under section 74, section 17.5, which talks about block credit, specifically states that any credit pursuant to an order or a proceeding under 74 will not be allowed as an input tax credit. So the issue or a challenge which will come up is that if it is under 74, then you will not be entitled to claim input credit on the same. Right? Also, this circular says that the maximum liability which can be, affixed on the person is that he has delayed payment of reverse charge mechanism. So interest can be levied on him, and plus there is a penalty of not raising the invoice. So that section 122 penalty up to 50,000 rupees can be levied. Okay. So this circular, in fact, can be used beneficially in other cases as well, assuming that your supplier has supplied certain goods in 2021 or rendered services under in 2021, and he has raised the invoice because of some negotiation or because price not being fixed. He has delayed raising the invoice, and he raised the invoice for some reason. 2021 invoice he has raised in December 21, okay, which is well after the due date within which you should have claimed the credit for 2021. So he has raised it in December 21. Okay. Now the issue of the department was, they would say that, look, on the invoice it says services rendered for the financial year 2021. The last date for claiming credit for the invoices relating to 2021 was September 21. You have received the invoice itself in December 21, so you are not entitled to claim this credit. Now, using this circular, we can say that, look, the invoice is dated 21-22 because December 21 falls under financial year 21-22. If it falls under 21-22, the last date for claiming credit is September 22 and not September 21. And hence, I'm still entitled to claim the credit, and the credit is not time barred under section 16.4. I'm very loosely using the last dates of 16.4. We will come to the last section of this presentation. There we will discuss on what are the extended timelines for section 16.4. As of now, for all the examples, I'm using only September as the last date. Okay. Now section 200, circular 212 addresses a situation covered under section 15.3. Now, what section 15.3 would say is that if you are providing any post-supply discount, then you are entitled to reduce the discount from your turnover only based on a condition that the recipient has reversed the input tax credit. Now, how would this be worked, or how would department monitor is, if I am the supplier, I will raise the invoice of 1 lakh. And after that, because of some quantity discount which I am giving to my customer, I will issue a credit note. When I issue the credit note, the recipient was required to accept that credit note in his GSTR 2, so that his credit reduces or his output tax liability reduces. So there was a one-to-one matching between what I upload versus what he accepts or what he rejects. Now there was a audit trail, or a trail which was possible to check whether I have uploaded the credit note and the other person has reduced his input credit or not. Because this mechanism could not be implemented at all on the GST portal, now as a stopgap arrangement, that onus of whether the recipient has reversed the credit or not has moved from the GST portal to the taxpayer. Now, as a supplier, if I have to claim deduction of that credit note, I will have to go to all my customers where the value is less than 5 lakh rupees, okay, of the discount, and tell them, you give me a self-certification, okay, that you have reversed ITC for whatever credit notes I have issued to you. If the value is more than 5 lakh rupees, then I will have to ask my recipient to get the similar declaration, but from a chartered accountant or from a cost accountant. Okay, so the onus which was on the portal to link has now been moved to the taxpayer. Now the taxpayer who is giving the discount, post-supply discount, will have to collect these declarations and submit this along at the time of audit or inspection. Okay, there will be some specific format in which the certificate is required to be issued, and specific fields will have to be mentioned, like what is the credit note number, what is the date of the credit note, to which invoice does this credit note relates to, how much of the amount of GST is being reversed. All those details we'll have to give. Okay, so this is not a mandatory requirement, this is only an optional requirement. If there are any other ways available for the officer to check, then he can check that. But I'm sure after this circular has come, no officer would want to look at any other alternatives. He would insist on getting a CA certificate or a self-declaration certificate. That is point number one. Point number two, if you look at this circular 212 very, very carefully, it talks about a certificate which is required to be issued, or a self-declaration which is required to be issued only in cases where the discount or the credit note has been issued pursuant to 15(3)(b). Okay, but the credit notes can be issued under section 34. Section 34 says that when you're returning the goods, when there is price negotiation, we're not talking about post-supply discount. Okay, post-supply discount is one of the species for which credit note is issued. But if the credit note is issued for anything other than 15(3)(b) purposes, then I would believe that this declaration is not required, because this declaration is restricted and required only for the purpose of post-supply discount and not for all the credit notes. Next, let's move to circular number 213. Now, what does, again, a department created issue where what would happen is, if there is a subsidiary company in India who is, to incentivize his employees, saying that from the parent company, I will get some shares allotted to you. Okay, so what the parent company would do is, parent company would issue the shares to the employee directly of the subsidiary company, and the cost of the shares would be debited to the Indian entity. Now, the GST authorities would say you have received services from the foreign entity, okay, to the extent of shares being issued to you. Now, the value of the shares has been debited by you, it has been debited to you, you are required to pay GST on the same. Okay, the circular says, now these transactions can be in two ways. One, the cost of the foreign company is debited to the Indian subsidiary. In that case, the transaction relates to issuance of security, which is neither goods nor services, and so it should not be taxed. And second, anyways, the issue of shares is a Schedule 3 transaction between employee and employer, and so from that perspective also it should not be taxed. Okay, but if there is any markup or commission which has been charged for the purpose of issuance of shares by the foreign company, then that markup or commission on that GST will have to be paid. So assuming for issuance the holding company is charging $1 lakh, then on that $1 lakh GST will be applicable. But the debit for the value of shares, which is say $15 lakh, on that $15 lakh there will be no GST. I do not agree with, I agree with the answer given by the circular, because that's beneficial for us. Not just that, because conceptually that is also right. But the reasoning given is, I am not able to digest that. See, what they are trying to say is, ESOP is a transaction between the employer, which is the Indian company, and the employee, who is also in India, and this transaction is covered under Schedule 3, so no need to pay tax. Of course, this is a transaction covered under Schedule 3. But the issue itself was not transaction between employer, that is holding company, subsidiary company, and the employee. The issue or the GST liability was arising on the ground that the holding company has provided services to Indian company. There was never a question of Indian company rendering services to the employee. So the circular, to the extent it connects to Schedule 3 and says it is part of the employment arrangement, I believe is completely incorrect, and that logic should not be used at all. But the conclusion, of course, is good, so we should use that. I'm sorry, in between I'll keep taking some break, so bear with me on this. Now, there are certain circulars which are specific to a particular industry, okay, and may not have relevance to any other industry, but just we'll try to cover those as well. Circular 214 talks about valuation of services as far as insurance business is concerned. So what happens is, sometimes the insurance has two components. One, the assurance component, where they say the premium is 1 lakh rupees, 60,000 rupees will go for assurance, that is your sum assured. 40,000 we will invest, and we will give you some guaranteed return, we will give you this return, we will give you that return, XYZ. Okay, So now if you look at the valuation rules, they say to the extent of investment, you are not providing any service. Okay, you are investing on behalf of the insurance holder. So that amount of investment of the premium, you are not required to discharge GST on the same. The issue now was that when the premium of 1 lakh is collected and GST is discharged only on 60,000, whether that 40,000 is treated as exempt service and are you required to reverse the input credit on the same or not. The circular now clarifies that that 40,000 rupees is neither nil rated nor exempt under section 11, but the deduction is available only because of a valuation mechanism, and hence to the extent of this 40,000 rupees, you are not required to reverse the input credit. Now this means in all the valuation mechanisms, wherever there is a reduction in value, because the valuation mechanism says so, you will not be required to reverse the credit because that deduction is a value discount and not a exemption which you are getting. Now again, on the insurance sector, circular 215, which says that there are two kinds of policies. Policy number one, where in case of a damage, say assuming there is a car, okay, and that car gets damaged, the insurance company will say the total value of damage which has been assessed is 1 lakh rupees, but you will be able to sell this car for 20,000 rupees. So I am giving you 80,000 rupees. In this case, the salvage value is not received by the insurance company, and so no GST is applicable on the same. Versus second case, the company says, you give me the entire scrap and I will pay you a lakh of rupees. So now the settlement with the insured is 1 lakh rupees. The insurance company is now going to sell the scrap at 20,000, 30,000, 10,000 rupees. In this case, the circular 215 says that in this case, the salvage, the leftover or the scrap of the car becomes the property of the insurance company, and they have sold that at whatever price. On the sale or disposal of that scrap, they are required to discharge the GST. Okay. Now we go to circular number 216. There were a lot of issues in circular with respect to warranty schemes, with respect to replacement given by the distributor on the behest of the manufacturer or the OEM, especially in automobiles. So assuming my car has a warranty of 1 year, okay, and there is some problem with the car because of which there are some parts which have to be replaced, and the OEM has told me that first 1 year anything to be replaced I will give it free of cost to you. There was a circular 195 which was issued, which talked about spares. Now circular 216 talks about the goods itself. So basically anything relating to warranty supplies or supplies on behalf of the OEM by the distributor is covered under two circulars, 195 and 216. Whether it is spare parts covered under 195 or goods itself covered under 216, all of it is covered. So now what is the issue here is that the distributor has purchased that spares, okay, from the manufacturer on which GST has been charged, and he has claimed input credit on that. Now, when I, as a customer, go to the distributor and say, look, this part is faulty, can you replace this and give it to me? He will replace the part, but he cannot charge me because I am going to him under warranty. Now, the distributor will say, the OEM, that on your behalf, I have supplied certain material. Please compensate me for this. There were different situations, there were different permutation and combination, there were different business practices which were being followed by every OEM. Now, this circular very clearly says that when the distributor replaces the product on behalf of OEM to the customer, please raise an invoice on the OEM, bill to OEM, ship to customer, okay, so that the OEM can claim the credit and you can discharge the GST by way of reverse the GST by way of paying output tax, okay. Or second, if the supply, the main supply was within the period on for which you can issue credit note, then please issue a credit note. So net the effect is that OEM will still be able to claim the input credit, okay, because it is part of their warranty supplies, meaning as part of their warranty claim, and the distributor also does not have to bear the loss for not using certain goods for his sale. Okay, that's what the circular says. Very nice circular, very beneficial circular. Okay, now we come to 217. Again, an industry level issue. Okay, just give me a minute. Again, an industry level issue. Circular to of insurance companies. What would happen in insurance companies is that assuming, again, we'll take the example of a car. I have purchased a car, okay, and I have taken insurance of the same. It meets, unfortunately, with a small accident, and so I get it repaired. Okay. Now I can tell the service center that I am covered under insurance. So why don't you speak to them and see what is to be approved, what will not be approved. So what they will do is the service center will now start communicating with the insurance company and get a fair idea that 60% of the expense, say 1 lakh rupees is the expense, 60% is covered by insurance, 40% is not covered by insurance. They will give me two invoices. 60,000 rupees will be in the name of the insurance company and 40,000 will be in my name. And on both of it, GST will be charged. The insurance company would say that I have incurred the 60,000 expense in the course of my business. And so I am entitled to input tax credit. The GST authorities would say that the service is on the car of somebody, which is not you. So you have not received the services, and so you are not entitled to claim the credit. Now, Circular 217 says that it is the insurance company who is the recipient of the service, because end of the day they pay, and recipient for the purpose of GST means the person who makes the payment. So to the extent of 60,000, the insurance company is the recipient, and so they will be entitled to claim the credit, provided they have, meaning it is part of the claim which they are processing. But if the repair bill for the insurance company is 70,000, okay, but the claim is only 60,000 rupees, then the credit should be restricted to the extent of the amount which has been reimbursed to them. Okay. Third, if the entire value of the invoice by mistake has been raised on the car buyer, okay, or the driver of the car, and not on the insurance company, even then the insurance company will not be able to claim the credit. So that means for the insurance company to claim the credit, point number one, the invoice should be in their name. The invoice should be to the extent of claim which is being processed by them. Only then they will be entitled to claim the credit. Otherwise, they will not be entitled to claim the input tax credit of the repair charges. Now, though Circular 217 has been issued in the context of motor vehicles, the logic should apply for all the industries as far as insurance is concerned. Okay. Circular 218, again a department created issue. What they would say is that if a related party, whether a foreign entity or the Indian entity, extends loan to another related party, whether a domestic company or another domestic related party, okay, then the loan is definitely not liable to tax, because loan is transaction money which is not liable to tax. But if this loan would have been given by the bank, it would have carried a processing fee of 1%. Okay, and because it is related party, you have not charged the processing fee of 1%. So this transaction falls under Schedule 1, where they say that transaction between related parties or distinct persons is liable to tax even if there is no consideration. And so when you are providing loan, it is a loan guarantee service, loan granting services which has been provided by the supplier to the recipient. If the supplier is outside India, then the recipient is required to pay tax in the reverse charge mechanism. If both supplier and recipient are in India, then the supplier is required to raise an invoice for 1%. So what they would do is they'll go to the balance sheet, related party transaction schedule, and wherever there are loans, they would ask for payment of taxes. Okay. Now, Circular 218 says that if you look at the exemption notification 12 of 2017, which talks about exemption from payment of tax on interest, discount, etc., it very clearly says that there should be a charge as far as processing, facilitating, or administrating the loan is concerned. But in case of transaction between related parties, there is no charge for processing, because there is no work required to be done. The loan is just given. Banks process the entire application. Okay. And so there is no service which is being rendered by one related party to another related party as far as extension of loan is concerned. And so there should be no levy of GST. So if you observe, a lot of these circulars are only yes and no. They're saying this is the question, this is the answer. So to a certain extent, government is very clear on the stand of what they want to tax, what they don't want to tax. But a lot of circulars, I don't agree to the logic which has been brought in. But as long as they are trade beneficial circulars, we will accept it with both the hands, right? Then again, a very specific issue, we will have to extrapolate it to other aspects as well. Circular 219 has been issued to clarify whether input tax credit can be claimed on ducts and manholes used in network optical fiber cables, okay, which are used for providing telecommunication services. Okay. Now, the section 17(5) C and D have been in a big debate, and the matter is before the Supreme Court also in Safari Retreat, which was decided in the favor of taxpayer in Orissa High Court. Okay. Now, what 17(5) C and D says is that if anything is used for construction of an immobile property and it is capitalized to that property, you are not entitled to claim the input tax credit of the same. Example, if I'm constructing a commercial complex, okay, which is an immobile property, and I'm not intending that for sale, but using it for generating rent. In that case, the cost incurred by me for construction of that immobile property, I'm not entitled to claim ITC on the same. Okay, there's no logic which has been given here in as to why the credit has to be blocked, because without incurring that construction cost, I would not have built a building, and without that building, I will not be able to generate revenue on which I am discharging GST. Okay, but now the issue was whether the ducts and manholes which are used to which have to be taken into account for the purpose of providing telecommunication services for creating the network of optical fiber cables, that is OFC, whether the credit on the same should be available. Now it has been clarified that these ducts and manholes definitely form part of the plant and machinery because they are used as part of OFC, and there is no immobile property which is coming into existence, and so credit should be available on the same. Using the same logic, there is a possibility to debate, or there is a possible argument which we can take, that the AC ducting which is required for the purpose of installation of ACs, the credit on that also should be made available, because that is not leading to construction of an immobile property, but it just enhances my experience of an immobile property. Okay, so there is a possibility to claim credit as far as air conditioners are concerned based on this additional logic, though we had few other logics also, that air conditioner anyways is a planted machinery and it's a standalone product and not related to immobile property. But this circular 290 gives us an additional argument on why the credit should be made available. Okay, now circular 220 is for banking institutions where they were providing custodial services to the customer. Now if you look at section 13(8)(a), which is the same section which also talks about intermediary services, the place of supply is the place where the bank is operating. So what would happen in case of custodial services? The bank, if it is operating outside India, then that will become the place of supply. If the bank is operating in India, that will become the place of supply. So the credit could also be a problem. The place of supply would be a problem, and all those issues would come. Okay, so now they've said custodial services are services which have not been rendered to the account holders, and 13(8)(a) will come into picture only when the services are rendered to account holders. And since the custodial services are not to account holders, the place of supply cannot be determined based on 13(8)(a), which is the location of the service provider, but will be determined based on the default rule 13(2), which is the location of the recipient. Okay. Though I've not dealt so much with this custodial services, but that's what I could infer based on the circular. Now, circular 221, so many notices on this to all the road construction contractors. Advance rulings filed. NHI gave some clarification, meaning internal circulars to each of the contractors. A retrospective amendment was made, but too much of confusion on this specific HAM projects. Okay, hybrid annuity model. Now, here what happens is, we take an example. I want to bid for a tender for construction of a road, and so I have to submit the tender document before NHI. The value of the entire contract says 100 crores. So NHI will say your bid is accepted, assuming I'm a L1. Okay. NHI says bid is accepted. Okay. And this 100 crores, what I will do is, in very simple terms, not to complicate things, 60 crores I will pay over the next 4 years till the time road is completed. Complete the road within 4 years and I will give you 60 crores based on milestones. Okay, assuming 25% every year. Okay, not easy, because these are milestone driven payments of how much work have you done, but for ease of understanding. Okay, the balance 40 crores I will pay you spread over the next 10 years. So this contract is not just for construction, but also maintaining the road for 10 years after the date of construction. Okay, 60% I will give you now, 40% along with interest on that 40%, I will give you spread over the next 10 years. Okay, and this will be an annuity. So a fixed sum will be given to me, factoring the interest, like our EMIs. I take a loan of 1 crore and I'll keep paying EMI, that is same amount I will keep paying over the life of the loan. Okay. Now the issue was the GST authorities would say that, look, your work was to construct the road, which has already been constructed in the 4th year. The NHAI has delayed the payment, but work is complete. Okay. So because the work is complete, on the day when the work is complete, you are required to discharge GST on the entire value of the project and not just 60%. Okay, so again a welcome circular here which says that don't bother about all these things. It says HAM is a continuous supply for the entire period of the project, which is first 4 years plus the next 10 years. As and when the event gets complete, which requires you to receive the payment, not when you complete the construction of the road, which requires you to receive the payment from the NHI, that will be treated as the time of supply, and based on that you are required to discharge the GST. So for the first 60%, I will have to raise invoice 25% each into 60% for the first 4 years. Then for the next 10 years, depending on my agreement, whatever amount is mentioned, I will keep raising that invoice, discharging the GST, and getting the money from the NHA. And that I will not pay the entire tax of 100% on the in year 4 itself. Next, we go to circular number 222. Again, the issue was with respect to time of supply as far as spectrum allocation services which were rendered by the government. So spectrum allocation services rendered by the government was like exploitation of natural resources liable to tax under reverse charge mechanism. There, the contract itself gives you two options. One, you make a full payment, or second, you make a deferred payment, and the deferred payment requires you to make some payment for interest also. Okay. So here again, the argument of the department was that you have received the services on the first day itself, but you are taking the option of making the payment on installment basis. Merely because you are paying the tax on the value on installment basis, the time of supply does not get postponed. You are required to pay tax on the first day itself. This circular says if you pay the full amount on the first day, then you are required to pay tax on the full amount. But if you have opted for deferred payment, then the time of supply also gets postponed to the date when you are paying or you are liable to pay, and the time and based on that you are required to discharge the GST. Okay. If you would have seen, I have skipped one more circular, circular 223, not very relevant. Moving to circular number 224. Okay, much awaited clarity, but not very happy with the clarification. Now, what some portion good, some portion bad. Okay, there are two aspects to this circular 224. Also, there is an amendment to that, so I will cover both of it together itself. Okay, so what happens is we get an order. An order has 5 issues. We accept 2 issues. We want to litigate on 3 issues. So as soon as we get an order for 2 issues or we get a show cause notice for 2 issues, what we do? We pay the tax by DRC 03. Okay. Now the department is not able to map whether this DRC 03 is for this order or for some other order. Okay. So they are saying you please prove that this amount which you have paid through DRC 03 is for this order only, or they will say at the time of filing the appeal, you should have mentioned disputed amount, undisputed amount, disputed amount pay 10%, undisputed amount pay the full amount. Okay, because you have not done whatever you have paid, I don't know what is it for. If it is for this only, claim refund, but at the time of filing the appeal, you pay the tax again. Okay, that was the issue which was arising. Now what government is planning to do is they are planning to release another form DRC03A, not available as of now, but form DRC03A will be issued. So wherever a demand is created or an order is created, you will be able to pay tax against that order. Okay, so that is against that order only, so no confusion at all. But if you have paid something through DRC03, then you can file DRC03A, pick that order and say this DRC03 relates to this order. Okay, and then a confirmation will be issued to you in DRC04 that yes, this office, this GST office has adjusted this DRC03 against this order. Okay, similarly, if you have not filed the appeal online, but you have filed manually, or because of some technical glitches, or because of lack of awareness, you have not made the pre-deposit at the time of filing the appeal, but you have made the pre-deposit under DRC03, then what you can do is you can again go to this option of DRC03A, link it to the relevant order, and that once a DRC04 is issued, it would mean that the payment has been made towards that order. That means that will be counted for the purpose of computation of pre-deposit payment made by you. Okay. Another point, what they said is, if you intend to file an appeal before the tribunal, okay, if you intend to file an appeal before the tribunal, please file a declaration with the GST authorities, that is the person who has issued the order, and to a jurisdictional officer that you want to file an appeal against this order, and whenever the tribunal window opens, you will be filing the appeal. So that is one important thing. If you are waiting for the tribunal to form, please file the declaration in any form. Okay. Second, very unfortunate. When you file the appeal before the tribunal, you are required to make a pre-deposit. Currently, it is 20%. It is additional 20%. So first 10% you would have already paid at appellate stage. Additional 20% you are required to pay. So that means at tribunal stage you should pay 30%. Now there is a proposed amendment to reduce that additional 20% to additional 10%. So effectively, when you are before the tribunal, you will be paying a pre-deposit of only 20. Only is also very huge only, right? But only 20% you will be paying. Okay. So now what the circular says is, when you file the declaration, and please use the DRC03 and pay that pre-deposit of 20%, because the law has still not been amended. So pay the pre-deposit of 20%. And whenever the window for filing the appeal opens, okay, you file the appeal and mention that the pre-deposit has been paid through DRC03. So now what is happening is, for the fault of the government of not setting up tribunal, within 3 months time of the order, I will have to file a declaration and I will have to also make a pre-deposit. So assuming the tribunal does not come for the next 5 years, still I will have to pay a pre-deposit today, wait for 5 years for the tribunal to set up, file the appeal, and then wait for an indefinite period when my appeal comes up for hearing, when my case comes up for hearing. Okay. Right. Now we go to circular 225. So we spent quite a good amount of time, and we are still in circulars. That many number of circulars have been issued actually. Okay. So now what does the circular say? Again, a department created issue, I would believe. Corporate guarantee. Now, what do you mean by corporate guarantee? I am a holding company. I am huge. I have assets. I have had turnover of 1,000 crores. So I have a lot of employees. I have a lot of bank accounts. I have a lot of debtors, creditors, inventory. So quite a huge organization. I have started a subsidiary, and that subsidiary, to start its operation, requires a loan. So it goes to the bank and says, please give me loan. The banker says, no, I will not be able to, because you don't have any assets, you don't have any collaterals. What you can do is, you get a guarantee from your holding company that in case you default, then the holding company is going to repay the loan to me. So now there is an agreement entered into between the holding company and the bank, that in case the subsidiary company defaults in making payment of the loans, then the holding company is going to compensate the bank. Okay. Now, if this guarantee of compensation would have been given by the bank, it is called bank guarantee. Because a corporate is giving, this called corporate guarantee. Okay. So the issue was, the department was saying again that if you would have received this bank guarantee from the bank would have charged you minimum 1% as processing fee. Because you are buying it from a related party, you are not paying the processing fee. So transaction covered the schedule 1, please pay GST on the same to the supplier, or the person who is issuing the bank guarantee. Okay. On 26th of October 2023, Rule 28.2 was amended, was introduced actually for the first time, to say that in case of bank guarantee, whatever you do, the value is 1%. Okay, whatever might be the value, whatever might be the assumption here, whether it is taxable, not taxable, according to me, it is 1% or the actual amount charged. Okay. Now there were a lot of issues around it. First of all, whether can a valuation mechanism decide whether something is taxable or not? That's a fundamental issue. Okay, we'll not get into that. But second issue is that 1% has to be calculated on per annum basis. Should it be calculated on the loan actually disbursed, or the loan limit which can be disbursed? Okay. What if there are two people who are giving the guarantee? So all these questions were there. To answer those questions, circular 225 was issued. But just before that, we also have to look at the amendment which has been made to Rule 28.2. Now, Rule 28.2 has been retrospectively amended, okay, to say that as long as the recipient is able to claim the credit, the value mentioned on the invoice will be treated as the open market value, and if the invoice is never raised, then nil will be deemed to be the value. So as far as related parties is concerned, where the recipient is entitled to claim the credit, the value of the corporate guarantee can be zero also. The issue now is the corporate guarantee is given for 10 years because the loan tenure is 10 years. Out of 10, one of the years, okay, in one of the years there is an exempt supply. Then how do we value it? That is another question. Okay, so we'll deal with those complex questions a little later. But as of now, let's try absorbing what is the amendment. So the amendment now says that as far as input credit is allowed, whatever is the value you want to decide, that is the value on which GST can be discharged, as long as ITC is available. Okay, but if the ITC is not available, then the value of the corporate guarantee is 1% of the guarantee amount. Okay, and this rule will apply only for corporate guarantees issued after 26/10/2023, which means that any corporate guarantee given before 26/10/2023 will be ruled by 28(1) only, which is open market value. Okay, again we'll come down to 1% only, because open market value means what generally is charged, and what generally is charged I have no idea, so we'll go with 1%. Okay, it also clarifies that assuming that the corporate guarantee is given for 10 crores, but the loan actually disbursed because the limit was 10 crores, but the requirement was only 5 crores, then whether GST is required to be paid on 5 crores or it has to be paid on 10 crores. The circular now clarifies we are trying to tax on the value of the corporate guarantee. Okay, and the corporate guarantee is 10 crores. So whether the loan granted is 10 crores or 5 crores, it does not bother. I don't bother about that. You are required to discharge GST on that full value only, and not on the partial. Okay, that is point number 1. Now, second, in case the loan is taken over, okay, by some other bank. So is there? So I had taken loan from company A. I have moved it to, sorry, bank A. I have moved it to bank B. So whether corporate guarantee is required, if GST is required to be discharged on the same amount. It says only if a fresh guarantee, okay, is given or the existing guarantee is renewed, then tax is required to be discharged. Otherwise, there is no requirement of paying GST on the corporate guarantee. Third, what if there are multiple guarantors, which is there are two companies, one is covering a risk of 60%, the other is covering the risk of 40%, then that 1% also has to be bifurcated between 60% and 40%. 60% one guy will bear, 40% the other guy will bear. Okay. Next, what is the time of supply? Very, very important. Okay. 1 second. Somebody is there on the door. Okay. So, what if the corporate guarantee is given? What is the time of supply? Very, very strangely, okay, very, very strangely, what it is saying is, if the tenure of the corporate guarantee is 1% per annum, 1% per annum, okay, that means you have to keep paying every year. But if the corporate guarantee tenure is 7 years or say 5 years, they give an example of 5 years, okay, then you don't have to wait to pay the taxes 1% per annum. You pay the taxes upfront itself on the day corporate guarantee is issued. 1% into 5 years, 5%. So that means if the tenure of the loan is 10 years, okay, and the corporate guarantee is also issued for 10 years, then unfortunately the tax will have to be paid for 1% into 10, which is 10% on the date of issuance of corporate guarantee. They also say that assuming the corporate guarantee is given only for 1 year and it is renewed every year, in required to pay tax at the rate of on the value of 1% for the next 10 years, or how many ever years it is renewed on a yearly basis. Okay, what this will ensure is that nobody enters into a corporate guarantee for 10 years. It will people will ensure, or the taxpayers will ensure, that they are entering into a corporate guarantee for 1 year to be renewed on an annual basis, to ensure that they defer the GST payment as far as corporate guarantee is concerned. This is apart from the ground that whether at all GST is applicable on the corporate guarantee or not. Okay. Next, on export of goods, this 226 is specifically for export of goods. On export of goods, what would happen is I would pay the tax on exports, and through the customs route, I would get the refund automatically when I am filing the shipping bill. Okay. But now, if there is a price escalation after the goods have been exported, in that case, the issue was how will I get refund of the IGST? So there is a detailed procedure which has been prescribed under Circular 226 to say that you file the form GSTR 1, pay the taxes, and under others category, okay, till we enable a new facility, you under the others category, you please file for a refund application for the price revision. So you exported at 1 lakh, it became 1,20,000 rupees. So on 1 lakh, you've already got the refund. On the 20,000, you pay the tax and you claim the refund under the others category of refund. Okay. Then two other circulars, 228 one circular covering a lot of issues. Circular 228 says that if you are paying anything to a RERA for any services which you avail from them, are you required to pay GST under reverse charge mechanism on the same or not? So they have clarified that RERA is a government entity, and so any services from a governmental authority, is covered under notification 12 of 2017, serial number 4, and so you are not required to pay GST on the same. Okay. Now, one very, very welcome decision by way of a circular. We can always discuss whether circular can give this kind of clarification or not. But again, a welcome circular, and so I'm sure we will embrace it. Is that if there is any accommodation services which is provided for a continuous period of more than 90 days, and the charge per person is less than 20,000 per month, okay, then that residential accommodation is exempt from GST from the date the notification is issued and even for the past period. Okay, so they have given this exemption by way of a circular retrospectively. Now, this is in the background that GST was exempt on renting of residential dwelling for residential purposes. The issue was whether PG given to students or the service apartments made available to the corporate employees, whether these was liable to tax or not. The argument in favor of no levy of tax was that this is residential accommodation only which is being given as residence. Okay, and it has all the attributes of a residence, and so exemption should be available. This is the department's contention that this is commercial activity. It is not a residential dwelling. Residential dwelling typically will have one room, one kitchen, but here there is no kitchen, there is a common kitchen. There is no washroom, there is a common washroom. So it's not a dwelling from that angle, and so GST is required to be discharged on the same. So there were two cases here. One was the Amrish Tyagarajan case, where the Karnataka High Court said it is not liable to GST, the PGs and the hostels. Also, there was Mukambika case before Chennai High Court, where they also mentioned that the PG given to working women or the girls of the college is a residential unit, and so exemption should be given. So, basis that and the representation made by the industry, this exemption has been given retrospectively for the earlier period as well as for the subsequent period. Okay. Now, there are a lot of other amendments also, which I would like to cover, but we are already exactly at 5. So what we'll do is, to the extent whatever we have discussed, we will take some questions, and if then time permits, okay, 5-10 minutes, then we'll just run through these amendments, because some of these amendments have already come. Some of these amendments require the GST law to be amended. So maybe I will request cash flow team to allow me to appear before you again once the amendments are notified. Few of them have already been enabled. So if there are questions, I will be more than happy to answer those. If there are not, then we'll see if we can come back to these amendments.
Hanish, we have a few questions. If you can check
Right.
the Q&A, yeah.
Yeah. So I've got one question, just 1 second. I am having a parallel system to just see I can read the circular whenever required. So this is a circular on question on circular 211. whether Circular 211 covers import of services cases on which tax is payable under RCM. Yes, sir. Even under import of services, you are required to raise the invoice on yourself. And because you're raising the invoice on yourself, that is self-invoice, that circular will be useful to you also. Any other questions, you please let me know.
We have one more question in the chat. It's regarding Circular 221. If you can check the chat.
Yes, sir. Akash, you have mentioned that whether ham is a continuous supply of service or not. It is continuous supply of service because it is a service for more than 3 months. Luckily for us, this Circular 221 has also acknowledged that there is a continuous supply of service. And so, as and when there is an obligation to receive the money, I will not say the word obligation, as and when I'm required to receive the money, that will determine the time of supply. And that is the logic based on which Circular 221 says that as and when you're supposed to receive the money, you discharge the tax, even though the road construction has happened much prior to that.
We have another one in the Q&A section by Rajashri.
Yeah, Rajshri is saying, what are the changes in GSTR 1A? Form GSTR and GSTR 1 is the same. Yeah, so GSTR 1A is exactly same as GSTR 1. But the point is, what was happening is that there was a lot of difference between, there was a gap between what was reported in GSTR 1 versus what was paid in GSTR 3B. And because of that, notices were being issued. Okay, so to reduce those notices, if you have filed your GSTR 1 but realize that you have done a mistake while filing GSTR 1, whatever amendments you could make in the invoice in the next month, they have allowed you to make those changes in GSTR 1 itself, or GSTR 1A. The thing is now GSTR 1A is only for comparison of liability between GSTR 1A with 3B, so that there is no difference. But whatever you report in 1A will be available as credit to your recipient only in the next month, because this will get auto-populated in the GSTR 2B of the next month. Okay, so from format perspective, there is no change. Okay, from the format perspective, there is no change because it's a extension of GSTR 1 itself. But it is only amendment of invoices which you have reported in GSTR 1 or reporting of new invoices. I can see a few more questions. 212, if party is deposited full invoice GST, however, if wish to pay 50%, how to claim in GST input? 1 second. This 212 is about credit note. So I will just read it out again, Deepika. I'm not able to follow the question. 212, if party is deposited full invoice GST, however, if you wish to pay 50%, how to claim GST input? Party is not interested to issue credit note to us. So now, if the party has already raised the invoice of 100, okay, and you are paying only 50%, point number one, you are entitled to credit of only 50% because you have under rule 37, you also have to satisfy whether you have paid full value of the invoice or not. And if you have not paid full value of the invoice, the credit is available only to the extent of payment made by you. Because you have made 50% payment, you can claim input credit of only 50%. Even though the other party, that is the seller, is not interested in issuing credit note to you. Because if he does not issue a credit note, that's a loss for him. He has reported a liability on 100, but you are paying him only 50.
We have another question by Ratna. Do we need to file nil returns when you have not provided any services during the quarter or the month?
Yeah, you have to file. I would encourage if we can restrict the questions to what we have discussed today. That will be easy, because otherwise GST is like an endless topic. We can keep going on discussing on GST. Okay. So, Ms. Ratna, to answer to your question, nil returns also are required to be filed. Okay. Then there is somebody who has asked for update on Amnesty Scheme. Section 168A will have to be introduced based on the recommendations of the GST Council. That section 168A will be introduced in the budget as what we are told, which will ensure that for 17, 18, 18, 19, 19, 20, wherever the notices were issued under section 73, and if you are not disputing the tax, you will get waiver of, we will get waiver of interest and penalty. Okay, but any other conditions, how do we apply, whether there is a form like we had in Sabka Vishwas scheme and all, we'll have to wait for the procedures to come once it forms part of the finance bill, and that it becomes part of the finance act. If rule 42 is applicable, example, sale of mutual fund, sale of land, etc., or any other cases, would it be presumed that full credit is not available? Rashid, very, very important question, and there is no ready answer to it. I would believe that if you are receiving any services, or if you're rendering services where the point is whether full ITC is available or not, then what you should do is you have to ensure that you should be able to prove that the services are not related to sale of mutual fund. That means it is not a common creditor. See, when will Rule 42 come into picture? Rule 42 has three aspects. It says whether it is exclusively used for common purposes, for exempt purposes, whether it is exclusively used for taxable purposes, or whether it is commonly used. If it is used only for taxable purposes, there's somebody who's releasing some balloons. I don't know what. Okay, right. So if somebody is using it only for taxable purposes, full credit is available. Using it for exempt purposes, no credit is available. If it is commonly used for taxable exempt, only then Rule 42 will come into picture. So if you are able to demonstrate that the services received by you are only for the purposes of taxable, meaning taxable activity, then you will not be required to reverse the input tax credit, which means full credit is available, which means valuation will have to be accepted. 1 second. There are questions in FAQ and then in chat, so I'm just juggling between the two. Venkat Raman sir is saying GSTR 1A and GSTR 1A are same. I think the question is GSTR 1 and 1A are same or not. They are not the same, but like A says, A means amendment. So anything in GSTR 1, if you want to amend, that is the facility given to you under 1A. Rahul has a question. How we can take RCM rate of earlier bill if bills are only booked, but we have not paid RCM at the time and paid during audit? Yeah, exactly what the circular says. The circular 211 says that if you raise the invoice now, because RCM is not based on the, if you're talking about registered persons will from whom you have taken the services which are liable to tax under RCM, that's not what the circular clarifies. Circular clarifies only on cases where you have to raise invoice on yourself. There the circular says that if you raise the invoice today, you will be entitled to claim the credit, and 16.4 will come into picture as if this invoice relates to the year in which the invoice has been raised. I hope I was very, the answer was little simple. Deepika says, can group company use the corporate guarantee? I am not sure what is the question here, Deepika. If you can rephrase and help me understand the question, I would be more than happy to respond to that. Okay. Also, in the meantime, what I will do is I will just share. Give me a second. This PPT I'll ask cash flow to share it with all of us after the session is over. Now, there's also a small QR code here. You can scan it and get added to our community, and you can post any questions which you have on our WhatsApp community, and we'll be happy to respond to those. Also, if there are any real life updates on GST, we will keep sharing on this community as well on a daily basis. Right, so this PPT will be shared. We'll again come back. There are a few more questions. Yeah, Deepika is elaborating on this. Under same director, if system consent can give corporate guarantee. Yes, the corporate guarantee can be given, and if the credit is available, then this circular will be useful. If the credit is not available, then we'll have to go to Rule 28.2, which says that corporate guarantee will be valued at 1%. Any other questions? I think, Sarai, you are on mute, yeah? Okay, so Chetan has a question. How to charge corporate guarantee 1% when guarantor are 3%? Is directed 1% onto each, and how to proportionate to each limit amounts for 10 crores? I'll just break this question. I think what Mr. Chetan is asking is the value of the guarantee is 10 crores and it is being given by 3 people. So how do we deduct this or allocate this 1%? So if your agreement very clearly says that company A will be liable for 60%, B will be liable for 30%, and C will be liable for 10%, then at 1% will be broken between A, B, and C in 60:30:10 ratio. Okay. But if there is no agreement at all and all are jointly and severally liable, then it will be divided equally. That's what the circular says. So everybody will be responsible for 33% of that 1%. Let's see one more question in. So regarding CA or self on ITC declaration during the assignment, can officer deny ITC based on such declaration? No, the circulars are binding. So unless there is a proof that the declaration is incorrect, or if they are able to prove that the declaration is fraudulently being obtained or issued, unless they have that kind of evidence, that declaration cannot be rejected by the officer. I think with this, I thank the cash flow team for inviting me to this session. Thanks a lot, yeah, and thanks a lot to everyone for attending this session. Thank you.
Thank you. Thank you so much, Hanish, for conducting this session. We'll share the PPT soon with all the attendees, as you said. And I would like to thank everyone who attended this session. We will keep you posted about our future webinars, and we hope to see you there. Thank you again, everybody, for joining us today. Thank you.
Thank you. Thank you.